Hello, hello, hello. Stuart Heath here, founder and CEO of Harvard Grace Capital, with part 11 of our Important Investing Terms series. I want to invite everyone to go to our website, download the book we've put together with the definitions, and you're welcome to have that for free. This week we're talking about what does investing have to do with your taxes? And as the pure bean counter that I am, everything has to do with taxes, frankly. But here's some key terms, especially for us real estate investors. Depreciation and bonus depreciation, your income statement, your pre-tax versus taxed retirement, phantom income, something to always look out for, and cash received income. So let's talk about depreciation. We've talked about this from a financial statement perspective, but it's also a concept in taxes. And then this bonus depreciation is a concept that pops up and then goes away and pops up again over the last 20, 30 years as the government seeks to stimulate the economy. So depreciation from tax purposes is very simple. The government prescribes tables and then very detailed definitions of what type of asset goes into each category, and based on that category, there's, all right, you get this number of years. And most tax depreciation from the get-go is what they call MACRS, which is Modified Accelerated Cost Recovery System, and it's essentially based. It essentially is an accelerated depreciation schedule, which is the basic system in tax. You can elect another system under tax, but I don't know if very many people do that because why not take the most deductions up front, which is what accelerated depreciation does. Bonus depreciation, in our most recent iteration, was put into law in the Tax Act of 2018 under President Trump. And it started out with 100% bonus depreciation for a few years, and then it would kick down to 80% and then 60%. And currently in 2024, we're at 40% bonus depreciation, and it's scheduled to phase out next year. Now, what that means, what does 100% bonus depreciation mean? So if you buy a certain type of asset, which is generally personal property, equipment, computers, things of that nature, then 100% of the cost of that asset is depreciated in year one. So it's a major boost to your cash flow in that it significantly reduces your taxes. So that's depreciation and bonus depreciation. The income statement is kind of where you start with taxes. You take your P&L, then you start making multiple adjustments to it to adjust your accounting profit and loss to a tax profit and loss, and that's how you calculate your taxable income. We talked about retirement before, pre-tax versus tax retirement. A Roth IRA, the simple example, a Roth IRA you put in post-tax, i.e. you've paid tax on the income you put into it, but you'll never pay tax on that income once it comes out. So it grows tax-free, and then you distribute it back out to yourself tax-free. Pre-tax would be more the traditional IRA or the 401ks, where you get a deduction currently to put money into your retirement plan. It grows tax-free until you start taking that out, and then it's taxed at that time. Phantom income, always a bad thing. It sounds bad, sounds horrible, and it is. If you are a member of a pass-through entity, that generates taxable income, and so it's going to pass that income out to you to pay tax on your personal return, unless that organization passes the cash along to you to pay the tax on its income, then you've got phantom income. You've got income and no cash, and that is no fun, and it does sometimes happen, but generally with good management, it does not. Cash received income is essentially that. Most taxpayers are cash basis taxpayers, and if you get cash, it is most likely taxable. There are a few notable exceptions, such as life insurance proceeds, inheritance, and things like that. Usually fairly rare and usually fairly sad when you get those kind of cash payments. But generally, when you get cash, you've got a tax to pay. Thanks for watching this one more time. Go out to the website, get the ebook we put together for you. Would love to hear your comments. Thanks.